Hi there, happy Monday. It's Colin Storm here with Keller Williams Realty of Falls Church. If you're getting this through my email list, you probably know that already. If you happen to be seeing this on YouTube, welcome and thank you for having a look. So I wanted to follow up after last week's election results. People have been asking me off and on all week, so now what can we expect? What can we expect in the real estate market, in the mortgage market, now that the election results are in, we're getting a new president, and we can expect some very different policies down the road? And the short answer is, I don't have a crystal ball. Nobody really has a crystal ball. I as a real estate agent, I help people buy and sell homes. I help people interpret the market that we're in and the dynamics of that. But we're not really the best at understanding with any certainty, what's going to happen in the even somewhat near term, but especially not the long term. And there's plenty of experts out there that would may try to pretend to have a crystal ball, but even a lot of the experts are guessing at the moment. I see some people talking about some volatility in the overall market, which could include the bond market, the treasury bond market, which does impact interest rates. And that's what we're seeing in terms of an immediate reaction post-election, is a reaction within the treasury bond market and thus mortgage rates. So in terms of a quick what's happening now, we do have definitive information on that. And so mortgage rates at the end of October, hopefully you guys can excuse me, can see this. At the end of October 31st, we were at about 3.59%. But then by Friday of last week, was this Friday or Thursday, the 10th? I'm not best with my dates. We were at 3.85, and now and I saw at the very least, Wells Fargo on Friday last week was up to 4% for a fixed rate 30-year mortgage, not jumbo, just a standard mortgage. And then I was looking at, I think it was Chase.com this morning. They were in that high 3% rate, 3.87 if I'm not mistaken. But that was with a point, so 1% rate buy down of the purchase price would get you the 3.87%. So again, bond yields have gone up since the election, and thus the rates have gone up. And so in the near term, that impacts people's affordability. So if you could have afforded a $950,000 home last Monday, this Monday you may be, and that was your peak, absolute top. This Monday you might be looking more like, now we can only do $925,000, $900,000. So if you didn't lock in that rate previously, that rate has now gone up, and that affordability has gone down a little bit. Now, in terms of long-term impacts, if rates do go up, as this is not making a prediction. This is just market dynamics that I kind of suspect will be true. Our market, in terms of what is bolstering the market, is based on just a lot of standard fundamentals. So prices have been going up, prices have been strong, and that's because demand has remained high and inventory has remained relatively low by comparison. So that's bolstering prices, and that's going to be a healthy backstop as we kind of maybe navigate some ups and downs in the rates and some volatility there, or if even rates sustainably go up. If they just can sustain that upward trend here for a while, that supply-demand variable will bolster and again provide a backstop for prices. And what you'll probably see, and I've talked about this before, is as affordability changes, if you're selling a house for $950,000, say, you don't necessarily need to lower your price because the person who wanted to buy it now can only afford a $900,000 house. What's most likely going to happen for you is the person who is looking at a $1 million house will now come look at your house because they can't afford that one, but now they can afford yours. So the market slides down, will probably slide back and forth to meet the sellers, as opposed to in the near term, in the immediate anyways, as opposed to sellers having to chase a downward market. Because we have these different tiers. So that first wave, I suspect, will be buyers changing what they buy as opposed to sellers chasing those buyers. Again, that's kind of my thoughts on the immediate impact of what's happening now, and then what to potentially expect as that kind of unfolds. But as I mentioned already, nobody knows for sure what's going to happen in the near term, long term, there's some expectation of some deregulation, that the Fed now might be more likely to raise the Fed rate, which that's going to impact adjustable rate mortgages. If the Fed rate goes up, the adjustable rate mortgage rates go up. The 30-year fixed mortgage is attached to the Treasury bond yield only, and like a 15-year mortgage is attached to Treasury notes. Anyway, that's above my pay grade to even discuss that. If you really want to talk about that more, you can talk to a mortgage lender or a banker who's much more qualified. Anyway, if anybody has any questions and they want to reach out to me directly, by all means do that. I can talk to you about your situation and help you understand your dynamic, whether you own a house and just want to know what's going to happen with your value, whether you need to sell sometime in the next year or so. Maybe you're going to be leaving the area with the current administration, or if, a company that's attached to the policies of the administration, or maybe you're looking to buy and want to understand what your affordability is going to be. Should you lock now? What does all that look like? We can put you in touch with a lender to talk about that more intelligently than you could with me, but we can at least start that conversation. Anyhow, I don't want to ramble on too much, but again, that's kind of what's going on. Have any questions, reach out. Always happy to help you guys. Again, my specialty isn't necessarily having that crystal ball and understanding the market, but I am really good at interpreting the market that we're in and helping people make decisions within that. So if I can help you with that, let me know. Again, Colin Storm, Keller Williams Realty. Have a great Monday.